Well, I think we should go ahead and get started. So, call the meeting to order, and if Stacy will do the roll call.
Yes, good morning.
Good morning.
David Moore,
Present.
Mark Gardner,
Here.
Stephanie Elliott Williams, David Holly, Karen Savage, Flora Barisha, Gregory Coleman,
Present.
Janita Costin,
Present.
Brian Birnbaum,
Here.
Jim Whitney,
Present.
Tom Shanley.
Present.
We do not have a quorum.
All right. With that, I guess we skip over approval of the minutes from the last two meetings. And we can go straight to the portfolio review with Greystone.
Great. Thanks, Landon. It's nice to be here in person to see everyone. Before I turn it over to Jim, I just want to kind of let everybody know the results we're going to talk about are in a format that looks a little bit different than what you're used to. And the reason for that is because we do not have up-to-date information on the alternative investments portfolio, so we can't give you an accurate total fund return through the first quarter of this year yet. We will produce the report that we typically produce, which has a lot of detail and around results and pieces of the portfolio when that data becomes available. What we're going to talk about today when we talk about results is the public markets portion of the portfolio. So stocks and bonds. We're going to leave out the alts. And the alts are about 8% of the portfolio. So it's not a huge percentage, but it's typical for these things to take a little bit of time to get updated information to be able to calculate an accurate return. Any questions about that?
Did you get the full year 23 results for the alternatives?
We do have those. Those are current, correct.
Because I think at the at the last meeting, you probably didn't have the full 2023 results, including the alts.
Right.
Do you know offhand if they helped or hurt last year?
Well, I would,
Relative?
just speaking off the top of my head, so stocks were up over 20% last year. Bonds were up, I think, about 8%. I would say that the alts probably hurt. But relative to a benchmark, they were in line, plus or minus. So not a material benefit or detractor from results for the full year.
Remind me, how is the alternatives benchmark?
So we have about 60. So again, we've got 8% at the total fund level that's in investments that are categorized as alternatives. Within that 8%, about 60% of it is real estate, and about 40% of it is multi-strategy hedge funds.
So it's probably like that NCREIF index or something for the real estate, and then
and
the hedge fund is like
fund index for the alts piece. Yep.
And that does those benchmarks are part of the total benchmark.
Correct. Yep.
So we can include the year-end alts when we have the first quarter. It's not, the underlying managers haven't distributed that information. It's not, we're not.
Yeah. It's just, I think,
it's timing.
as you know, it takes a bit of time to get current data on that stuff. So. Okay. If there are no other questions, I'm going to actually turn it over to Jim, talk about Outlook. I'm going to come back and talk about capital markets during the first quarter and then go into portfolio results.
Okay. So we are going to turn to slide 9. We'll walk you through Thanks. So the amount of economic data, the markets have moved very quickly as a result. So I'll try and fill in some of the blanks since these charts were created as we go. First chart we're looking at is slide 9 on the left side. What we've seen since the October low is a straight shot up, almost 30%, as you can see from this line on the S&P 500. And most of this ascent was based off the fact that premise that the Fed was going to cut rates 6 times. That was the estimate at the start of the year. And that we'd be moving into a disinflationary environment. We'll come back and talk about that in a few minutes, but clearly that's changed quite a bit. And we haven't even had a correction prior to April of more than 3% in that time period. We did have a down month in April. The S&P was down a little over 4%. NASDAQ was down about 4.5%. And that's really an adjustment to inflation is not rolling over as the Fed hoped. And based on the Fed meeting and comments yesterday, it's not clear that the Fed's even going to cut one time in 2024. So let's move to the next slide, slide 10 for a moment. There's a lot of information on this slide. I'm going to focus on the left side of this slide. But I think it really tells the story. That the green line is the expected Fed funds rate, futures Fed funds rate, at December 2024. So that is now held at around 4.7%. The blue line is a 10-year Treasury. Today that's right around 4.60, so it's pretty close. And then the dark blue line is the forward 12-month PE. It's inverted and it's pinned to the left axis. So where that PE line is going down, it just means the market's getting more expensive. So this rally has defied expectations. You know, if someone would have told me that the Fed funds rate would be up, 10-year Treasury would be up, inflation would be up, I don't think I would have guessed that the valuation of the overall market would be up as well. And so now the forward earnings multiple on the S&P it's somewhere between 21, 22 times earnings. So quite a disconnect. Looking at the next slide, we're going to go a little deeper on earnings, left side of slide 11. What we're looking at here is earnings, forward earnings, going back to 22. I'll focus on 2023 for a moment. That green line, it's important to note that line's been coming down for quite some time, and it's now at about 245. It's moved up a little bit since the first quarter. We had strong numbers from some very large tech companies. So it may be around 247, 250, but it's fairly flat, and this is when the economy is stronger than expected. So if the economy is stronger than expected, we would have hoped that the earnings line for this year would have been moving upward. And it's been flat for quite some time, absent this little bit of bump that we're experiencing here in the first quarter. And you can see that's about 10% higher than it was last year. And as we're approaching June, pretty soon the market's going to be discounting 2025 earnings and less focused on 2024. And you can see from the purple bar that 276 has been also pretty constant, and that's about 13% higher than where we are today. So we think about that in terms of today's valuation. Valuations looked a little stretched, and we've got about a 13% increase in earnings expectation for 2025 over 2024 in an economy that the Fed wants to slow. So I think that's going to be a tough, if not choppy, environment. Slide 12, I'm just going to spend a moment here, and Brian will talk a little bit more about this, but this is the growth to value index, and when that line is going up, growth is doing better. There's been a lot of discussion about the Mag 7 and FANG stocks and the impact AI has on the market. It's been very concentrated. It's been well discussed in the media. And what we've seen here at the beginning of 2024, it's hard to know if this is a trend, but the market has broadened out in terms of those stocks that are moving up. It's not just this concentrated bunch anymore, and there's been a resurgence in value stocks. Again, it's way too early to define any trend, but it's interesting that we have these long periods of time where value works, growth works, and perhaps investors are looking at growth stocks and saying those are really full in terms of valuations. On slide 13, focus your attention on the right. Top right, we're looking at the core PCE. This is annualized. That's the Personal Consumption Expenditures Index. And below that is the better known core CPI. The important thing here is in both inflation measures, we strip out volatile food and energy to get a better sense of what underlying inflation is in the economy. There's differences between the core CPI and the core PCE. The weights are a little different, the scope is slightly different, but the story is the same. And the story is that inflation is not tamed. Here we're looking at inflation on a 1, 3, 6, and 12-month basis. That's what the different color-coordinated numbers represent. And what we're seeing is that it's year over year, it's running hotter than expected. So we've had some really stubborn parts that the Fed is struggling with, rents being one. And if we look at rent as a percentage of the CPI, it's about 35% of the CPI. So we really do need some movement in rent to get that CPI number lower. I think the other area that's been pesky and unrelenting is insurance. If we look at homeowners insurance, that's been up 7 to 10%. And that's really a result that there's too many homes built in areas where there's exposure to hurricanes, flooding, fires, etc. So that looks unrelenting. The shocking number has actually been in the auto insurance area, and that's up about 22% year over year. So this last mile to get to 2%, it's tough, very difficult for the Fed. So we're not surprised at all that they're going to keep the current Fed funds rate until they start to see a clear path to this 2%. But if we look at this data over the last 12 months, it is not going in the right direction. We're moving away from the 2%.
Do y'all know how what's behind the auto insurance thing? I'm not really that familiar with how insurance works. Is it based on sort of experience of claims, or is it forward-looking? Is it inflation catching up with that stuff?
I think it's the latter. Things are more expensive to fix today. And
that sort of lags.
Yeah.
Insurance premiums kind of lag a little bit.
So the average new car price is since the pandemic is probably up 20 to 25%. Right. Same car. And so driving rates were much lower, obviously, during COVID. So now we have much more expensive cars on the road, and so driving accidents increase, and the cost to repair those vehicles is dramatically higher than it was pre-COVID. So the insurance companies, coming out of COVID, they were operating at a loss because the insurance claims were so high for these expensive vehicles. So what happens is they raise premiums to cover.
Shouldn't they have made a lot of money when no one was driving?
They did. Then they cut that. I think they cut everybody's rates.
Funny how that works.
They booked it.
cost to repair all the technologies.
Yeah, the hybrids and
Yep.
This is the other challenge for the Fed on slide 14 on the left side. This is wage growth, and we've dissected it for low, mid-wage, and high-wage segments of the economy. The story is really the same. The numbers are still high. They're rolling over, not as high as the 5.5% we saw here, but on Tuesday of this week, we had the employment cost index released, and that showed that these numbers were much higher than expected. The new numbers are at 4.4% from a year ago. And this includes effects from the minimum wage increases that took place in the United States. About half of the United States had minimum wage increases. So those numbers were reflected in the employment cost index number that was released on Tuesday of this week. And when this happens, this just erodes the confidence of the Fed to move towards cutting rates. And this is one of the stickiest parts, because wage inflation is very difficult to reverse. Very difficult to reverse. And there's a knock-on effect, which we'll look at on the next slide. So I showed you a number of slides that suggested that inflation's still running relatively hot relative to the Fed's expectation, and valuations have gone up. So what could be driving this? And I think this slide sort of summarizes it. Upper left, we're looking at U.S. GDP growth. We ended the year with real GDP growth at 3.4%. That's a very solid number for economic growth. And the forecasts for 2024 and first quarter 2025, these numbers have been revised up since the start of the year. So they're around 2.5%, and that's a pretty strong economy. There's nothing recessionary about that in any way. So the U.S. economy really does refuse to land. Consumer spending was revised up last week from 2.9 to 3.4%. Those are strong numbers. So that's not a hard landing or a soft landing. That is no landing. The consumer continues. They just did not get that recessionary memo. Disposable income keeps going up. And we ask ourselves, well, why is that happening? Well, we have, at the bottom right, we've got unemployment. And unemployment last month was 3.8%. So by virtually any economist's definition, that 3.8%, that's full employment. So we look at 3.8% full employment, and it's no surprise then that wages are going up. It's still a competitive workforce. People are changing jobs, and the switching of jobs usually results in higher than the average 4.5% wage increase. It's closer to 5.5%. So, and also with 3.8% unemployment, there's a lot of discretionary income that flows into the real economy. In addition, so we've got wage increases, we've got newcomers. We have about 6 million new immigrants in this country, and some of those are working, and that money is being spent on this side of the border rather than on the other side of the border. And then we also have almost 20 million new retirees that have continued to spend. This is the richest cohort of retirees that we've ever seen in the country. And they are spending on everything from transportation, hotels, anything travel-related, restaurants, and all those, and healthcare services. So putting a lot of stress and demand. I think if you've been on a plane recently, it's almost always completely full. Hotels are completely full. So those are the three components that we attribute to why the spending's been so high. The last thing I'll point out on this slide is the upper right. And I think this is really fascinating. This is the expected number of Fed rate cuts in 2024. And really at the turn of the year, it was right about 6 cuts. So Fed was we were on this disinflationary environment. The economy was slowing. We're clearly on a path to 2%. And now that forecast is hanging by a thread at 1. That's a consensus. So that's quite a shift. I think it tells us all that the global economy, the U.S. economy, is wildly complicated, and that the tools that the Federal Reserve uses to forecast the economy aren't that great, because it's just wildly complicated. The Fed really wants to cut rates. That was clear from yesterday's press conference. They really want to cut rates. I don't think they want to be the Federal Reserve that waited and called inflation transitory, and now we had 10% inflation, and then on the back end be the Federal Reserve that waited too long to cut and caused a hard landing and severe recession. So, but we're not there. One more slide. I'll go through and I'll turn it back to Brian on slide 16. This is, I think, very interesting as well, because it's a disconnect from what's happening in the broader economy. And I'm focusing on the upper left for a minute. And this is the Small Business Confidence Index. And it's the National Federation of Independent Businesses represents about 75-80% of small businesses. And small businesses hire about 2/3 of Americans. And this confidence index is now where it was in 2012. So completely disconnected from the broader economy. Going a little bit deeper into the survey, the feedback was about 25% of these small businesses said inflation was their biggest challenge. So their costs are rising, and an inability to pass along those costs. And the second biggest issue small businesses have is the quality of labor. Very, very few, under like 7%, suggested it was actually economic demand. So that's just their margins are getting squeezed. On bottom left, we are looking at leveraged loans. These are riskier loans by their nature. Companies that lenders view these as already having above average risk. It is starting to tick up. We are starting to see some signs of stress in the credit markets, which is typically the canary in the coal mine. And if we look to the right, this is, we talk a lot about the real estate mortgage debt securities, and there's about $1 trillion that needs to be refinanced this year. So far, it seems to be going okay, and the market was well aware of this, but we'll see if it causes any indigestion. Last slide I'll just mention here is on the left side of slide 17. This is commodities. As you all know, commodities are very economically sensitive, and this just demonstrates a growing belief that the economy is going to remain resilient. We're seeing oil prices and copper prices move up. And copper prices are now at a 2-year high. And the risk for oil, of course, is an expansion of the war in the Mideast and putting pressure on oil prices. So those are our thoughts. Happy to take questions before I turn it over to Brian.
It looks like earning reports have been pretty good this quarter, but I did notice like Starbucks, McDonald's, their forecast for the rest of the year looked like slower growth. What's your take on that?
So it's still, we're working our way through earnings season, first quarter earnings, and we can say that what has been reported so far, which is probably close to 40% of companies, have been above expectations by about 9%. So that 2024 earnings line chart I showed you, that has ticked up. That's really good news, because that's what the market needs to grow into this expanded valuation. If you dissect the McDonald's call, which I agree with you was very interesting, their comments were that the lower end consumer is really struggling, and they've got to find better ways to drive value for that consumer. That's where the pinch was in the McDonald's earnings. Starbucks is a completely different case. It's a different target consumer, and there, I just think they hit the paywall. You know, at $5 a cup of coffee and long lines, people just said, "I'll do something else."
Their labor costs were hurting too.
And high labor costs. All of these are being impacted by rising minimum wages. You know, $20 in California as it went into effect. That's
You're expecting a strong employment number tomorrow?
well, we're at 3.8%, and there's, given how strong consumer spending has been, there's no indication to us that it's going to be a surprise. Likely to tick up a little bit. That's what the Fed is hoping for. But still, we've been sub 4% for 29 months.
The Fed is so conflicted.
Yeah.
With their like hoping employment is bad, but that's actually part of their mandate to keep it low.
Yeah, they will never say that, but because they want full employment, but they need prices to come into to
And I
get
think
the Goldilocks scenario.
they painted themselves in a corner a little bit, because they had come out last year and said, you know, look, inflation's coming down, we could start to think about cutting rates, and now all of a sudden we have this reacceleration. In some sense, they can't really go back on what they said. If they didn't say it, and if I were last year and I were a betting man, I would say the risk is greater to higher rates in this environment than lower.
It's at sub 4% employment to get to 2% inflation is really difficult.
It's the services labor rates that are driving a lot of it.
And when they're sub 4%, those wage rates just keep going up
They're going to continue.
because it's a hyper-competitive labor market. It then flows through the P&L of businesses.
So as a segue to Brian, I'd say, you know, that's a lot of information on just how the market's doing, and I'd say how do you summarize your view, and how are you expressing it in the portfolio? And are there any, changes to the strategy?
I would say our view's evolving, particularly in light of yesterday. So we're not going to have, we haven't had a chance to discuss it or incorporate any potential changes. But let's talk about where we are positioned in some of the things we're thinking about in terms of, in some sense, continuing the de-risking process of the portfolio that we started last year. So where were we positioned? It was our view late last year, in addition to consensus view that Jim showed you, that we were going to see a number of rate cuts this year. And that typically benefits things like smaller companies in the United States. So in light of that view, we had been overweight small cap stocks. We'd also been relatively close to the market in terms of duration positioning. We weren't long, but we were relatively close to the market in terms of duration positioning. As we've seen consensus and our own expectations start to take down the number of rate cuts this year, we've started to question whether it continues to make sense to keep a small cap overweight. And in fact, towards the end of last year, we made a change in the portfolio where we consolidated 2 of our small cap managers into a single manager, and at the same time, we somewhat reduced that exposure. So we got a little bit closer to benchmark. We're still overweight, but we got a little bit closer to benchmark. Today, where there is, despite what the Fed said yesterday, at least as likely of either a rise in interest rates or higher for much, much longer than the market expected, as there is a potential rate cut this year, we're starting to question whether it makes sense to continue to bring that relative positioning down. And just to give you a sense as to the magnitude of the positioning, it's not in here, I jotted some stuff down this morning. If you looked at the Russell 3000 stock index, which is a broad measure of the U.S. equity market, about 7% of that index is comprised of small company stocks in the U.S. That is historically low, very low. And the reason it's so low is because, well, big cap stocks have outperformed small cap stocks by so much for such an extended period of time. Really coming out of the global financial crisis, the best place in the world to be has been large cap U.S. stocks. So what are we, 12, 15 years past the global financial crisis? When you have basically an uninterrupted string of years of outperformance of big cap stocks relative to small cap stocks, that weight in the index declines. So again, within the Russell 2000, within the Russell 3000, the Russell 2000 represents about 7% of that index. Our portfolio today has about 10. Not a huge weight, overweight, but significant enough to where it impacts performance. When you get periods of time, and you can't, I apologize, you can't see it really on the picture here, but it's on page 2. S&P 500 index was up about 10.5% in the first quarter of this year. Russell 2000 index was up 5. Okay, half of the return. Even though we're overweight by a small amount, 3 percentage points, that has an impact on our relative performance. So the question to us now is, do we still believe in small cap? And part of the reason, the other reason why we believed in small cap stocks, in addition to at last year, we felt the consensus was that interest rates were going to start to come down, which typically, historically benefits small cap stocks. There is also a significant valuation difference. Jim talked about valuation in the U.S. equity market. It's primarily driven by the big cap technology names, which are in some areas trading at relatively lofty valuations. You have the opposite effect in the small cap space. Because they haven't returned as much as the big cap stocks, there is an increasing spread in terms of how much you have to pay for $1 of earnings growth in small cap land versus big cap land. Those were the 2 reasons why we were overweight those names. So fast forward to where we are today with this evolving perspective on where interest rates are heading. You still have the valuation benefit, but you don't necessarily have the interest rate tailwind at your back, based on sort of ours and consensus view. So again, we may decide to rein in that bet a little bit, not undo it completely, but dial it back a little bit, de-risk the portfolio, get a little bit closer to benchmark. So Landon, I would say from an overall portfolio positioning perspective, that is the primary area of focus for us. And if we were to make a change, that would be the likely next change we would make. Okay.
I have heard that the small cap play has been was a popular position for this year, and it hasn't worked.
Hasn't worked.
But it's been the whole growth U.S. and large cap, just
That's it.
the train will not stop.
Now, we made a lot of changes last year to bring better balance into the portfolio vis-a-vis where benchmarks exposures are. Again, we still had some relative positioning relative to the benchmark that didn't work, and that's what is kind of driving performance. But with the changing landscape, we think it's a good time to sort of reevaluate that positioning. Again, it wasn't a huge bet going in, but when you have a 2x return from large cap in a single quarter, that and you're overweight something that didn't do as well, that has an impact. The other thing that we think about is what's really driving earnings, what's driving stock prices today. And it's, despite that there was a little bit of a rotation in the first quarter where things like energy did well, things like financials did well, technology still did well. And you look at the earnings reports today, these days, and in the current period, who are the companies that are doing well? Well, it's Microsoft, it's Google, it's Amazon. All of these companies are spending massive amounts of money on their technology spend, and in particular, their technology spend related to AI, large language models. And who are the primary beneficiaries of that large technology spend? It's the other big tech companies, NVIDIA. And so we're at the very, very, very early stages of this sort of technological innovation. It happens to be occurring in the biggest companies in the index. This is relatively new, right? I mean, it's not a yesterday kind of thing, but AI and the hype and the hope of AI really started to take off the early part of last year. But it's clear to us that we're in the very early stages of this sort of evolution, and being able to, in NVIDIA's case, the ability to sell every single product that they produce, and will have years line of sight ahead of them to be able to continue to do that. Granted, those stocks have become a little bit expensive, but to Jim's point, the reality, and it's not to say it's going to be a straight line here, but when you have that long of a runway in terms of what your demand profile looks like, and to the extent that you can produce that stuff, you have earnings growth for the foreseeable future. So there's a lot wrapped into that decision. Again, I'm not saying that we're dead set on making it. We're having that conversation. In all likelihood, we'll probably pull back a little bit on that exposure because of that lack of maybe of an interest rate tailwind, and the earnings growth profile of these big cap names continues to be very, very strong. Let me make a couple of other comments on the markets, if I could. We get a lot of questions around, boy, this is a presidential election year. I'm worried. I'm not worried. So, what is our perspective on the election? And not to say that we have a forecast as to who's going to win or not going to win, and what's going to happen with Congress. That's not what I'm talking about. But we went back to 1928. There have been 24 presidential election years between 1928 and, I guess the last one was in 2020. The average return on the S&P 500 during a presidential election year was a positive 11.5%. So the tendency of markets, regardless of who wins, Republicans, Democrats, split Congress, whatever, the tendency of the stock market is to go up in presidential election years. There were 4 years, only 4, where that didn't hold. 2 during the Great Depression. 1 was 2020 with the crash of the TMT bubble. And the 4th one was in 2008, the global financial crisis. So I would argue that there were a lot of things going on in those 4 years, not necessarily related to a presidential election, that was driving the market lower. But again, we wouldn't be too concerned about the outcome of the election being the determinant of whether stocks do well or poorly this year.
And that's the year of the election, not like the year
Correct.
after the election?
Correct.
Didn't 2020, wasn't that still an up year?
No, 2020 we were down 9%. And then 2028 down 37.
I don't know what I was thinking. I thought 20, even though we had the huge dip in the middle, I thought we made it all back.
In 2020? In 2020, sorry, did I say 2020? So the 4 years that were negative were 2 during the Great Depression, 2000,
Oh, 2000, yep.
and then
dot-com bubble.
2008.
Okay,
So,
that makes sense.
Well, there'll be noise the closer we get to the election, but the outcome of the election really isn't going to determine the direction of the markets this year.
In the first year of the term, generally an up year for the markets too.
Yep, that's true too. We all sort of wring our hands about outcomes, and politics can have a big impact on sort of sentiment, but it can add to volatility. But the reality is stock prices are driven by economic fundamentals. Companies are growing. That outweighs really anything that's going on in Washington. And you can look at it in today's environment where we're spending massive amounts of money still. And corporate earnings are a lot stronger than expected. So it's much more driven by what's going on at the economic level and the corporate earnings level than noise that comes out of Washington. A couple other things. Slide 3 here. It's a quick snapshot of non-U.S. equity markets. Reference the S&P up 10.5% for the first quarter of this year. It was, believe it or not, the second best place to be. Not the best place to be. Best place in the U.S., but Japan was a little bit stronger than the U.S. equity market, up 11%. Broad non-U.S. equity markets up 6%. So we continue to see the U.S. equity markets leading the world. Emerging markets up about 2.4%. On the bond side, on page 4, interest rates ticked higher as the market started to reprice expectations for future Fed rate cuts. In fact, we saw the 10-year Treasury go from about 390 at the end of the year to about 420. So we saw a 30 basis point backup in 10-year rates. That led to lower bond prices. Corporate bonds were the place to be in particular, corporate bonds of high yield issuers. They were up about 1.5% in the quarter. I'm going to skip ahead, again, recognizing that the data here is not completely accurate. So I'm not going to talk about total fund returns. I'm going to talk about public equity markets. I'm going to talk about fixed income markets because we don't have the updated alts numbers. Before I do that, on slide 22, this is a quick snapshot of where our portfolio is positioned. We've got about 72% of the portfolio in stocks. Our target is 70%. And a little bit underweight in fixed income. It's about 20.5%, close enough to 21. Our target there is about 22%. So a little bit more in stocks. The remainder, once we get updated data, will be in alternatives. So on page 24, here are the results. So at the very top line, this is sort of a consolidated return of our equities, U.S., non-U.S. emerging markets. This is an accurate number. We're up about 7.1% in the quarter. It lagged the broad global equity markets return of about 7.7%. What was driving that? We had some, as I mentioned earlier, you can see in the U.S. equity market, right below that, we lagged. That's being driven principally by an overweight to small cap stocks, and small cap stocks not doing as well as large cap stocks. Again, as I mentioned in my comments earlier, we reduced our small cap weight at the end of last year as we consolidated 2 managers into one, but we still went into the quarter with an overweight positioning there. Emerging markets did a little bit better than benchmark. Non-U.S. equities did a little bit worse than benchmark. So small cap weighting a little bit, and the next slide I'll show you the performance of some of the active managers there, but that was the primary driver of the underperformance. On the bond side, you'll recall last year, the early part of last year, we made, I guess it was in the spring, we made a change to the composition of the fixed income portfolio. For years, we had BlackRock as a manager of ours. We moved away from them. We brought in Loomis Sayles. That decision proved to work quite well. In the quarter here, you can see we're not only outperforming the benchmark there, but generating a slightly positive return, even though the bond market was down about 0.8%. And over the last 12 months, significant outperformance. So that decision that we made there is working quite well, and we feel quite good about the composition of the fixed income portfolio. The other thing, let me just mention this, because at the end of the first quarter, we are now 3 quarters into the current plan year. As you know, contributions to the pension plan and actuarial evaluation happens at the end of June, well, with data at the end of June of each year. So it's really important from a cash contribution perspective that we're generating returns consistent with the actuarial assumed rate of return, which is 7.25%? Yeah. 7.25%. For the 12 months ending June of last year, our portfolio was up 10.1. So significant level of performance, excess performance relative to the assumed rate of return. If I were just to take the current quarter's number, which at the bottom of this table on page 24 shows on a net of fee basis 4.93%, I know that number's wrong, and it's understated in all likelihood once we get updated alternatives data. If I were to take that 4.93% and take the prior other quarters in the current plan year, so that we have 3 quarters worth, through the end of the first quarter, running at about 10.7% for this plan year. Now, we gave some back in April. Markets were negative in April. But we're certainly tracking for the current plan year to be definitely slightly higher than the 7.25 assumed rate of return. So we still got 2 months to go. We'll see how that finishes out, but we're looking pretty good relative to the 7.25. On page 26, here are the individual portfolio returns. Focus on a couple of managers. I'm just going to focus on some of the active managers here. This includes not only the active managers, but the passive stuff we've got as well. Aristotle is the first active manager we have. This is a large cap value focused manager. You can see they lagged during the period, 740 versus 899. You can see the longer term results are quite strong there. This is a manager, by the way, that has a little bit of growth in their portfolio, not just value stocks, and the way they define value is, and really any manager is changing today. versus what it's been historically. So they think about companies like Meta and Microsoft as more value-oriented managers or value-oriented companies. Yes, they have significant earnings growth, but that's a big reason why you see over the longer period of time some strong performance relative to a value benchmark. The new manager we put in place about a third of the way down this table is new small cap managers, Earnest Partners. You can see they lagged during the first quarter. They've been put in place the middle of December. This is the wrong benchmark for them. I apologize for that. We're showing them against a mid-cap benchmark. They are a small and mid-cap manager. A more appropriate benchmark for them is the Russell 2500. And that was up closer to 6.5%, not 8.5%. So yes, they still underperformed. It's one quarter. We're not concerned about it, but the relative performance difference is much narrower relative to an appropriate benchmark. On the non-U.S. side, right below that, you can see Capital Group International doing a bit better than benchmark, Harding and Loevner doing a bit worse, and then on the EM side, you can see those managers below. In addition to looking at and debating whether we need to change our small cap positioning, we're also going to be looking at portfolio construction within the non-U.S. components of the portfolio to see what changes, if any, we need to make. I have a bias, and I know Jim does too, of streamlining exposures. We don't need to make this portfolio overly complicated, so it wouldn't surprise me if we can consolidate some of the non-U.S. positioning into a smaller number and concentrate those bets a little bit more effectively.
So the Capital Group and Harding Loevner,
Yeah.
are they only buying ADRs in the portfolios?
They are, and that's one of the things we're going to be looking at.
Do you have any idea how much is it like of the market the ADRs
Yeah.
represent?
Well, so the ADR market has significantly evolved over the years to be much more reflective of what the ordinary market looks overseas. However, it's still missing a number of areas, and not necessarily in developed markets, but for example, there's very few Indian ADRs. And so you really need to focus on kind of, ordinary shares in places like emerging markets. I think the reality is within the ordinary share market, there is just simply much more that active managers can do. And so the way we think about, there's been a number of research papers written on this about what is it that active managers need to be successful. One is they need to have some insight into markets or stocks that is unique. And then the second thing they need is the ability to apply those decisions to lots of independent opportunities. And so to the extent that the ADR market is limiting what the opportunities are, then we're in some sense tying the hands of active managers who may have unique insights into those stocks. So we want to potentially broaden that opportunity set available to them so that we get the full power of the insights that they have.
Doesn't Morgan Stanley create a lot of those ADRs? It's like sponsored ADRs, and there's like unsponsored ADRs, and investment banks go out there and just create them.
It requires an intermediary to create them and hold the shares in trust. I don't know if Morgan Stanley is a big player in that space or not.
Well, it doesn't matter. I just we looked at it one time because our Smithfield's parent company has an unsponsored ADR out there that somebody made, and we looked into who the intermediary was. Anyway.
It could have been. So those are the things we're thinking about. Again, we can't tell you a good total fund return yet relative to a benchmark. But on the public market side, behind a little bit. We talked about some of the changes we're contemplating there. We'll obviously come back with any changes that have been made at the next meeting. But the good news, again, at least through the end of the first quarter, we're tracking well ahead of the assumed rate of return, which is good from a city cash contribution perspective. Any other questions?
And we'll have the updated numbers, yes, a couple weeks.
Couple weeks, I would think.
And you'll
We'll,
share those with
yeah.
We'll
Yep.
circulate that
Stacy,
with,
Flora?
Yep.
Yep.
Okay, well, thanks.
All right. I'll provide a quick update here. Stacy, I'm not sure if you can
Yes.
bring up one of the documents, if you want to just bring up the one that starts COP funded status
Yes,
first.
I could do that.
Is that not working? Let me see. I'll give it a shot.
Here. See if there's a way to see it.
I don't think it is. You can try.
All right.
Let's see how it goes.
All right, so that's a little, I know that print's a little small for the
Yeah,
screen,
let's
but I can just give you a quick summary. I just wanted to give an update. Perfect, thank you very much. So if we scroll down just a little bit, so this is the quarterly funded status, scroll a little bit more, that looks at estimates based on activity in the plan. That looks great right there. So we break it out first by the two systems. We'll look at fire, police, supplemental, and then combined. So this is really just showing, and Brian has alluded to some of this, we're in the third quarter of the plan year. That last grid box on the bottom looks at the most recent quarter activity. And so good news to report based on the combined strength of the annual required contribution, all being made in February for the year, as well as some positive market performance. The projected funded status of the portfolios have increased. So if we look as of March 31st, 2024, we're right around 72.25% for fire and police, and that is up from the close of the last plan year, as well as thankfully up from the end of 2023. And you'll see the contributions there for this system were $6.6 million. Stacy, if you don't mind going to the bottom of the next page, it's the same look for the supplemental system. Excellent. So again, similar results, because again, it's a combined portfolio that's driving the performance. You see the contributions from the city at $1.8 million. That increased funding status here to a little bit over 75.5% as of the end of March. So if we go to the bottom of the next page, we see again that combined look. And what we're seeing is around a 4% increase from the beginning of the plan year through current state. So the combined system is right around 73% from a projected funded status standpoint. And again, driven by, you see the 8.4 million combined contributions. And then we're using estimated investment returns that take into account the activity, but looking at around a positive 8.8 million based on those returns. And again, as we've continued to talk about, there's that constant high level of benefit payments being paid. And so you see just for the quarter there, around $7 million is getting paid out on a quarterly basis. But again, overall good news right now. To Brian's point, hopefully we see some continued solid performance in the market where we can close around those levels or higher once we hit the end of June.
Tom, is the liabilities trend, it's coming down, is that in line with the actuary studies?
Yes, so we're still very much in line, and I mean, the projected outflows based on distributions is going to be high still for, a handful of years, and then we'll start to see that start to decline.
And it's about 1,000 people, is that right?
Just under 1,000
1,000.
people now, and yeah, we're almost at 100% of people receiving benefits. And I'll show that too. So Stacy, if you want to jump into the next presentation. This one's a little bit bigger. I'm not planning on going through all of it. One thing I did want to mention that's up front is, as Stacy brings this up, if you want to just go to page 2, and actually this might work for me.
From a sort of statistics, probability, all that stuff, at what point is the number of people get to be small enough that your sort of projections get less accurate? And where is that is there an inflection point that?
Yeah, I would probably leave that more to John to comment on, the actuary, but I think as we've talked about this system, not all, but a great majority of the liability is locked in just based on the fact that it's been frozen for so long that the vast majority of the individuals are in pay. What's really going to impact it most is the contributions that the city's making and then overall investment performance. And we do know life expectancy does continue to increase. I know we've talked about the impacts here just based on fire and police and how that doesn't necessarily always stay in line with full increases in life expectancy, but we do look to updated actuarial charts to base that in every couple of years as well. So I just wanted to pause here for a second. I don't talk a lot about the team that's in place. I know you all have met John Morrison. He's the consulting actuary that works on the program. Tracy Anderson, she works out of our home office. She does all the heavy lifting on the ongoing administration. She works a lot with Mr. Coleman's team, keeps everything going straight. And then we also have internal individuals that assist John and Tracy, as well as a lot of the work, well, not as much work we do anymore with Morgan Stanley, but there was a period of time where the asset transfer was a little bit higher than it is now. Now we have a process in place where on a monthly basis, we're looking at how much cash we have on hand, and we work to fulfill cash needs to pay out benefits now that everything's held outside of John Hancock in the investment strategies that Morgan Stanley has. I just wanted to comment that after 15 years working with the city, I've been transitioning into a new role, staying with John Hancock, but I will be coming off of the opportunity of working with the city of Portsmouth. It's been a pleasure, quite honestly, to come down here and to work with you all. A lot of faces and people have changed, but I think the consistent has been there's always been members of the board that have been all in and really dedicated, and same thing on the side of the city. So I've worked with a number of great partners through the year. You're going to be in good hands, though, because on this slide here, I'm introducing, although he isn't here, but a gentleman by the name of Perry Wilkes will step in and fulfill the relationship management duties of the overall program oversight. Perry's been with our organization since 2015. He has over 30 years of both financial consulting and record-keeping experience. So Perry's based out of Atlanta. Perry was introduced a few months back to Jim and Brian. I know I've had a conversation, Landon, with you. I'd had a quick conversation with Mimi about it before her departure, but I'll set up an opportunity to introduce Perry to some members of the team that do a lot of the ongoing administration of the plan, and potentially the new city manager if there's interest too, just so that he has awareness of who the lead is at our organization. But really the core of what we do remains consistent, and that will be continue to be led by Tracy Anderson, who I know you all haven't met, but she does a lot of as I said, the work on the ongoing system. So just a couple of quick updates. I'm gonna skip through the next section. So every couple of years, I do put in a small section just as an overview of everything that John Hancock does for the system. I do that primarily for new board members and new members of the city, since I wasn't sure if we would have new members here today. So since we don't, I'll move through this pretty quickly, but just making a couple of general comments. Again, this what we do, we service both, corporate, municipality, Taft-Hartley union plans, retirement plans and systems, both on defined benefit, defined contribution, and non-qualified. So we have a whole host of different types of customers and clients. For the city of Portsmouth, obviously it's just pension-based, and it's been a frozen system, as we've talked about, for a number of years. So a lot of what we're built to do, we don't necessarily have to do for the population, because for the most part, individuals, we just need to make sure they keep getting their benefit checks. But we do have a host of resources available for individuals. Years past, we have done meetings. We have come to the city and helped retirees prepare to take benefit payments. Individuals can access their account if they need to via mobile or on the desktop. But then a lot of the important work that we do now for the system here is based from what we call our benefits consulting group. That's a lot of our actuarial work. We have a strong actuarial team. It's all done in-house. And we've been doing this work really back to the early 70s into the 60s, and really have built a consultative approach, both from an actuarial standpoint and ongoing ERISA and fiduciary needs. I know we've also helped Derek in the past with some fiduciary training, and we always have resources available to do those things. This just talks about all of the administration we do. Again, essentially, at this point, we're ensuring that the data flows and updates that need to come back and forth between us and the city work smoothly. More importantly, we get out all checks, payments, ACHs to members, and we have a call center that supports all of that as well. And individuals can go online and model benefits and start their benefit payments through a digital aspect or by contacting us. All of this is locked down with high levels of security. I typically have talked in the summer and the fall just to give an update on cybersecurity, so I'm sure Perry will do the same. So that was just a quick run through, but again, as new members come on or new individuals get involved, we're always happy to go through an overview of the work we do. All right, so just a quick look at the system. Again, those assets are estimated based on, again, waiting for some of the final numbers. Landon, to your point, we're at 984 individuals, so just under 1,000 now combined. And then, if you take a look here, this just looks at the activity in the system. So this is fire and police. All the way over to the right, you see there's only one active remaining. That one active individual is in their 50s, and they've been in the plan and in the system for a long period of time. Outside of that, there are only 38 other individuals who have not started benefits, right? So again, 608 of 647 folks in the system are already receiving benefits. This is a quarter by quarter, just look at cash flow. I mentioned the 6.6 million contribution that came in Q1. And again, that's for the whole fiscal year or plan year. Down below, you just see the number of checks that are going out every month. So again, roughly 600 a month, 18 a quarter. You see that $5.1 million paid out for fire and police just in Q1. There's our lone active individual with more than 25 years of service. So I would expect that individual may be retiring soon. For participant activity we've seen during the quarter, we have seen a number of individuals, again, not huge numbers because there aren't many, but 6 folks have started the process to potentially start taking benefits. We had one change in a new periodic distribution that was due to a death, and the spouse continued payments in January. And then unfortunately 5 individuals reported as deceased during Q1, but always like to point out, the city's been giving benefits to a number of these individuals for many years, upwards of 23, 29 years, based on how the system was built. For supplemental, same update, 7 actives, 9 terms who have not started benefits, so just 16 folks that are not in pay. All individuals are over the age of 60. Cash flow, same story, contributions, and you see that consistent distribution of checks quarter to quarter. There's your years of service, and of course this makes sense because the system's been frozen for a long period of time. And then light activity, not many individuals are in this plan. There were reports of 5 deceased individuals, but again, except for 1, all had been receiving benefits for more than 20 years. All right, and then the last update is just a quick check-in on cost and expense. And again, we look to disclose this every quarter. This takes a look at really all the expenses that it takes to run the system, from the cost of investments, the consulting expertise, the work that we do, and then the total shown in the right-hand column. So roughly all in, right around 43 to 44 basis points. And that's really driven by, Brian and Jim's team really bringing down the overall investment management expense. You see the investment management is roughly around 27 basis points. So that's really helped bring down total expense to run the program. And then these are just, there's not a lot to show here because typically we would show out if we're holding a bunch of different investments on our side. All of the investments are really primarily in the account at Morgan Stanley, but that blended expense ratio of 27 basis points is shown there. And then we just hold a government money market to pay out benefits. And that's it. Any questions or anything else for me?
Well, thanks. Appreciate your contributions to the city over the time that I've been here.
Yeah, no, it's been, this is one of the places I have probably been to the most in my working career, so.
So I look forward to meeting, is it Percy?
Perry.
Perry.
Yeah. Yeah, and so Perry has the August meeting and the November meeting, so he'll plan on being here. And then, of course, John will be here to do the valuation overview in November as well.
Great.
Maybe we'll put Perry in front of City Council, too.
Nice. All right. I don't have anything else unless you do, Mark.
I'm good.
Okay, meeting adjourned.
Thank you.
Thank you.